a 20-year term at 38 and 50, would that be a different price than getting a 40-year term at 30?
Yeah, great question. Great question. Maybe. And the reason is that if you did it at 30 and you did a 20-year policy and then came back and got another 20 years when you were 50, your health is now a variable because you're going to have to prove you're healthy again when you're 50. If you assume the same health rating, then you can start to look at kind of how that would add up, right? The other thing is you have the opportunity cost of the money. If you start paying for a 40-year policy when you're 30, the price is going to be higher. So is there a higher opportunity cost with what you would have done with the difference in premiums that could have been invested elsewhere? So there's always kind of a mix and match going on there, but great question. Yeah. Yeah, go ahead.
Does the curve itself tend to stay constant over time, or does it change a lot?
It accelerates. Yeah, it accelerates. You mean as you get older, as the population gets older, or?
I mean, so you said you're on a different point in the curve, so the amount is higher. But the curve itself, does that change?
Great question. Yes. It has basically been following that it's been shallowing out to be less steep because people are living longer. So if a healthy 30-year-old is now living longer today in terms of life expectancy than when our parents were our age, right? So yeah, that's a great question. So it is shallowing out. They reassess them every once in a while for a company, but once they have their curve in there, everyone kind of fits on the curve somewhere. Yeah.
So I just want to make sure. You make a net present value calculation at the start of your term, and you say, I need this for the, if it's like, if I get hit by a bus tomorrow,
yes,
this is the amount of money I need.
Yes.
And then over the course of the next 10 years, you'll be earning the same income. And then if you get hit by a bus in 10 years, you're still getting the full policy, right?
Yes, unless you decide to reduce it. So the way to think of it is, and this is a great question to phrase it back, what does my insurance need look like? Well, my insurance need today, I'm thinking mostly about needs, replacing my income if something happens to me for my kids and for my wife, right? 10, 20 years from now, technically I've had 10 to 20 more years of earnings and savings. My balance sheet, the money that is now, that I haven't earned yet, the potential money that I haven't earned has now been realized and captured, right? So technically, my need for insurance has gone down, right? What you find for a lot of clients is that those needs get replaced with other needs or other wants. So people in their 50s have different sets of why they buy insurance than maybe someone would in their 20s or 30s. But you're totally right. If you were to just purely look at it as the need for my kid, the need for insurance would actually slope downwards each year that I survive. Right? Because I have fewer years to cover. Right? Yeah.
So, go through your term and nothing happens.
Yep.
You get it.
Congratulations, you get nothing. Yes. So if you go through your term and you survive, which is the most likely scenario, yep, you don't get anything back for it other than the peace of mind that if something had happened, your family would be taken care of. That's right. So that's where permanent insurance, coming back to that piece, that's where people tend to think about having a combination of the two in my experience. Term is the default because it's the cheapest. If you're a healthy 30-year-old getting $1 million of term insurance right now, it might be like $35 a month. So it's like it's not super expensive, especially if you're healthy. If you're getting permanent insurance, now you're changing it from an if to a when. And so think of it this way. It's kind of like buying the house, as I was using that analogy. You got to structure a mortgage payment to pay in enough over a certain period of years so that by the time you're done paying in, the insurance company, based on the curve, the average curve here, knows they're going to have enough money to pay your claim someday. And so what you find is, and I know I want to be cognizant of time here because I could go on way too long on this. When you look at defining the amount of need, I think is the most important thing. What most of you are going to find is that your group insurance through work, whatever employer you have, will give you some options for some life insurance. So it may be that you can check a box, and especially if you're not in the best of health or have a condition that would affect your curve here, the rates that you get through work may be more advantageous than what you could qualify for as an individual. But most of the time, the amount of coverage that you can get through work is not enough. So there usually is some amount you're supplementing outside. But the combination of those, and this gets back to your question earlier of like, if you have multiple insurances, is that an issue? At least in the life insurance bucket, they would all pay out. It's kind of like a light switch. You're either here or you're not, right? Binary results. And so, yes, all of those would pay out. Every time you apply for insurance, they underwrite you on the front end to say, how much do you really have? You know, like, My wife, if I told her I had 10 million of insurance, might behave differently every time we have a fight. You know, you gotta be careful. Gotta be careful. So yeah, so just from a concept of insurance, that's what I think, if to leave one takeaway, that present value of earnings, I would recommend that you think of it that way. And also remember that most of us in this room have more potential than we do balance sheet, right? Pretty much all of us and all the money we've sunk into our education has yet to bear fruit. So I think of it that way. Yeah. Yes. So you'll name beneficiaries. So for example, mine is payable to my wife as the primary. I have my contingent beneficiaries, or if something happens to her before I die, it goes to the kids. And then from there, we actually have a trust we set up that has all sorts of other stuff. But yep, so you can name as many and in as successive orders as you want. Yeah, that's a great question. Yeah.
Debt and covering debt with life insurance.
Yeah.
So if you don't have any dependents, if you die, like, who's your debt go to? Like, what's the debt?
Technically, it's your estate. But if there's nobody there, I mean, and Chris, correct me, it's fine. It's wiped clean, right? There's nowhere to go.
Yeah, that's one of the blessings of having no assets, right?
Yeah, nowhere to go. So yeah,
Nothing to pay.
your parents would not get the bill. The only way they would get the bill is if they co-signed on the loan.
I see. Okay.
What about if your spouse dies?
Yes.
If your spouse has debt?
It depends what kind of debt. If they took it out before you were married and it was student loans, a lot of times that still is not, they're not a cosigner, they're not on the hook for it. It was based on your life. But if it was loans that you took out with, like, after you were married, or if it was debt in both of your names, you're going to be on the hook for it. Mortgages are the biggest one, right?
Just like depression happened, if you kill yourself, do they still pay out?
Great question. That's one of my favorites. So dark. So yes, if you kill yourself, is there still a payout? The companies, apparently it was like the Wild West of insurance in the early 1900s where all this stuff was happening. So now there's kind of like standardized practices across the industry. Most companies, after 1 year, you can off yourself and it'll still pay out. And think of it this way. They don't know when you buy the policy, they make an evaluation on your health, all those things, right? Mental illness is what would lead, right? And so it's just like any other illness that could beset you. They just want to make sure you're not buying it with the purpose of, yeah, exactly. Yes. Any other death questions? All right. So just to wrap up, present value, we'll get back to some of this other stuff. If you know that you have enough coverage, I think that's the big one. Once you have dependents, it becomes really important. But we're going to talk about some other insurances that are more based on you, not just who you would leave behind if something happens to you. So is that cool? All right.